In this video, I'm going to demonstrate calculating variable overhead variances. So we're going to be order fulfillment services for .com merchants, and ultimately we're doing variable overhead, so we have to look at what we feel like drives our variable overhead, and they tell us that's going to be based upon direct labor hours, so that's important. We've got our actual information here, 120,000 actual items shipped. It took 2,300 direct labors. Again, I know we're not doing the direct labor variances, but because labor is driving variable overhead, that's why we're talking about that. The total incurred cost of variable overhead is $7,360. We also need the standards of the labor, 0.02 direct labor hours to fulfill an order, and we need the variable overhead rate standard of $3.25. Similar to my materials and labors, our starting point before we jump into the quantity and price variance for variable overhead is going back to our spending variance for our past chapter. And to do that, we first need our flexible budget or standard cost allowed. So let's first start out and figure out what's the standard number of hours we thought it took to ship the 120,000 items. 120,000 times 0.02 direct labor hours per item means we anticipated it would have taken 2,400 direct labor hours to ship those 120,000 items. Now take those 2,400 hours, multiply it times the standard variable overhead rate of $3.25. So our total standard variable overhead cost, or flexible budget, was $7,800. Now that we know that, compare that to the actual cost of variable overhead of $7,360 minus that standard cost allowed of $7,800, and the dollar difference is $440. We identify it as favorable here because we spent less than we anticipated. So very similar to what we did with the other variable manufacturing costs of material and labor, we're going to break down this spending variance between the price that we paid for variable overhead per direct labor hour versus the quantity of direct labor it actually took, and isolate those into two different variances. Very similar to what I talked about with labor, we're going to tweak the naming convention just a little bit. Instead of price and quantity, we're going to be rate and efficiency. So we're just tweaking the lingo a little bit in our formula. I'm going to start out with the variable overhead rate or price variance. That's going to be actual hours, because again, we're measuring this in direct labor hours, times the difference between the actual rate that we pay per direct labor hour minus the standard rate. So let's find the information in our scenario. The total actual number of direct labor hours was 2,300. The actual rate, they don't come out and give it to us, but we can figure it out. 7,360 total and variable overhead costs divided by 2,300 actual hours means that we paid $3.20 per direct labor hour for variable overhead. Keep in mind, this is not what we paid employees, this is what we paid for variable overhead. The standard rate is $3.25 per direct labor hours. So now that we know that information, 2,300 hours times the difference between $3.20 minus $3.25. And let's stop before we do the final calculation. Is this good or bad? Favorable or unfavorable? Well, this is going to be a good thing. We paid 5 cents less per hour, which saves us cost. So this is going to be favorable. 5 cents less times 2,300 hours is $115 favorable. Again, that's our rate or price variance. On the other hand, we also have our efficiency or quantity variance, and this should look just the same as we calculated for our direct labor also. Standard rate times the difference between the actual hours minus the standard hours. Again, we have most of this information. Standard rate is $3.25. actual hours is 2,300. We already solved for the standard hours as part of requirement 1. If you recall, we took our 120,000 items shipped times 0.02 direct labor hours per each item, and that got us to the standard of 2,400. Now, if we fill this in, $3.25 times the difference between 2,300 hours minus 2,400 hours. And I'll at least let you know, similar to what I did for our labor video, I'm leaving you to solve the last one on your own, but I'm going to at least give away that it's favorable. And why is it favorable? Because we saved 100 hours. 2,300 minus 2,400, that's a good thing. We didn't have to work our employees as much, times $3.25 per hour. So unlike our earlier examples with material and labor, where we had one was favorable, the other was unfavorable, we can also have them going the same direction, like these are both favorable. I'll also note, even though I didn't solve the final efficiency variance, if you add these both together, because they are going the same direction, it does add up to our $440 favorable spending variance. So hopefully that helped you out with some hints for variable overhead variances.